Hey, what's up, guys? Today, I wanted to share 3 different methods on how to boost your APR if you're yield farming concentrated liquidity pools, and the pros and cons for each strategy so that you know where the upside is and the downside is, so you actually make good investment decisions. I always talk about the downside for each strategy because I think it's very important to walk into each strategy and each investment knowing where you can lose money. If you don't know where you can lose money, then oftentimes you're going to lose money in the long term because you're going to be blindsided by those things. And if you don't know the concepts behind these strategies, I believe over a long period of time, like in the next 6 to 12 months, especially when we see a larger dump in the market, you're going to be losing a ton of money. So hopefully this video would prevent you from making these mistakes. And like always, this video is not financial advice. If you're new here, my name is Richard. I'm a yield farmer and DeFi investor. I focus mostly on concentrated liquidity pools because I like to take more altcoin risk. And concentrated liquidity pools is a great way to earn more yield while you wait for a lot of these coins to appreciate in value. So the first strategy is simply using leverage. There are a lot of different platforms like DeFi Tuna or Reverse Finance where you can use leverage. So if I go to DeFi Tuna, you can see Solana is trading at about $232 right now. And I could, for example, put on leverage and then adjust my range here. If I want a wider range LP, I could be looking at, like, for example, $150 to $350, right? So that's a relatively wider range LP. And I personally prefer a wider range strategy simply because it's lower risk than like a tighter range chasing strategy. So I can, for example, put in 10 Solana and then 2,300 USDC, and then maybe dial up my leverage to 1.25 or 1.5x, right? At 1.25, you can see that I would be buying this amount of Solana and then this amount of USDC. And depending on if I want to balance my short exposure or the long exposure, I could be buying a different ratio, right? If I want to short Solana a little bit because I believe that the prices is going to trend down, I could be buying more Solana because it's going to allow me to accumulate more Solana in this pool to pay back the loan, right? So if I go 100% Solana, for example, then I would be offsetting some of that long exposure. You can see that on this price appreciation chart, if the prices move up to $300, I would still make a little bit of money. But if the price moved too much, I would start losing money, right? And this is if I'm not earning any fees. And you can download this graph here and see, like, over 30 days, how much would you earn in the process if the price stays flat, and then if the price move up and down, right? But sometimes with a wider range strategy, it could be unprofitable if the yield is not greater than the borrowing cost. If you look at the borrowing cost here, over the last 24 hours, the APR is quite high. So it would be eating into your profit margin if you are running a wider range strategy. But if you're running a very tight range strategy, your risk is going to be very high as well. So there is downside to this strategy. And I personally am not running this strategy, especially when Solana's price is so high. So this strategy has a better risk to reward if Solana's price is lower. So let's say like you're buying 100% USDC, but then you got started when Solana was trading at $100, for example, right? Then it is much better to be taking on leverage at that point versus taking a leverage right now. But that's the idea behind it. And then you can do a similar thing with Reverse Finance. You could deposit into pools like ETH to USDC, borrow out some stablecoin, then you add back into that collateral LP. So that's how you could put leverage onto your position and earn more yield in the process. So let's go over the pros and cons here. The first is it's going to allow you to get a higher APR if you can beat your borrowing cost. I just showed you guys that the APR right now for DeFi Tuna pools is about like 20 something percent, right? But if your APR is around like 30 something percent on your entire pool, then you would be beating that borrowing cost, and then you're able to earn like an extra 10% APR on the borrowed capital. And this could boost your overall APR, but you're also taking on more risk. A lot of times, if you guys are getting higher APR, you're taking more risk in the process. If you're not taking more risk, but you're getting really high rewards, then it's often not going to be that sustainable because a lot of people are going to find those pools. They're going to drive down the APR and it's going to roughly match the risk, right? So the APR often normalize over time to match the risk. And it is relatively safe if you keep the leverage low, use wider ranges, get a good entry, and only use a portion of your portfolio. It's very important that you don't expose your entire portfolio to leverage if you guys are using leverage strategies. And there are other leverage strategies I share on my channel as well. So be sure to check that out, like the bull lever, the bear lever. But the main idea here, if you guys use leverage, is to keep the leverage low and only use a portion of your portfolio. This type of setup could also give you more capital gains if the prices move up. And a lot of these pools do accumulate assets like Solana or USDC. So that Solana portion of the fees would actually appreciate in value and give you more capital gains if the prices move up, right? But the bad thing about using leverage is the liquidation risk. So if we go back to DeFi Tuna, I'm borrowing USDC, you can see there's a liquidation point here that I need to worry about. And the higher the leverage, if I crank it to 2x, then the liquidation point is going to move quite high, right? So make sure that you are comfortable with that risk before you take out leverage. You should know your exact liquidation point before you even touch leverage. And this is the same if you are using lending and borrowing strategy. You should be calculating your liquidation point beforehand. And the borrowing cost can spike to like 20, 30% or even higher sometimes. When I last checked, it was around like 10, 12%. And now it's at like 22%, right? So that borrowing cost can eat into your profit margin, especially if you guys run safer, wider ranges like I do. So if prices do move down for Sol to USDC, and then you borrow like 100% stable coins, then you are going to have a harder time to pay back the loan, right? Especially if this is the only position that you have. That's why I always recommend not leveraging your entire portfolio. And you should have other positions that is earning an income so that you could deleverage if you really need to. So that's basically the overall of how to use leverage. And the next popular strategy is something I call like squeezing the range. So it's very easy to actually earn a high APR from concentrated liquidity pools. It doesn't take like rocket science to find the best pools, right? But what is really tricky is retaining that income. A lot of times, if you guys see people like getting a really high APR from tight ranges, then a lot of those APR is not going to be sustainable. For example, a Sol to USDC range of $200 to $250, or an ETH to USDC range of $4,000 to $5,000. That type of range is often not sustainable, and we can take a look at that a little bit later. But the pros of the strategy is that you can have a higher APR from squeezing the range, right? The way concentrated liquidity pools work is that if you set a tighter range, it gives traders and investors more liquidity at that particular range to make swaps more efficient, right? But it doesn't necessarily mean more profit for you if you can't stay in range for enough time before you need to rebalance. So you could be earning a high APR and you could outperform other strategies if the market moves sideways within range for a long time. So if Ethereum's price do grind between $4,000 to $5,000 for like, let's say 6 months, then of course you're going to be outperforming a lot of different strategies, right? But how often does the price stay in range in a very tight, narrow range? In my opinion, not very often in crypto at all. And it's very hard to predict the volatility of the market, right? Because a black swan event could always be around the corner. And if you're basically into a lot of these tight range strategies, you're going to be suffering a lot of losses when the market does dump. And sometimes we do see huge dumps, like ETH did drop from like $4,000 all the way to $1,500. So more than 50% dump on your pool, and you would be earning no yield in the process if you were running a tight range strategy. So that's something to consider. And these are a list of cons for the tight range strategy. And I've tried a bunch of different strategies. I'm just not a big fan of the tight range strategy, if you can't tell. But here are the cons that you need to know. Number one, it's very hard to stay in range. So the APR you see on the screen is very unsustainable. So let's say you see like 50% to 100% APR. But the APR metric is if you stay in range for an entire year, right? And that's not really like a realistic thing for a tight range strategy, especially on like blue chip assets and like pairs like ETH to Bitcoin. A lot of times, if you guys are chasing the range with those types of pools, you're going to be giving up a lot of your gains back to impermanent loss that you will be locking in when you're rebalancing. To keep the APR high when you're rebalancing, you're going to be locking in a ton of impermanent loss because you can't really expand your range to minimize impermanent loss if you rebalance with a tight range strategy, because when you do that, you're going to be dropping your APR, right? The APR is very unsustainable. You're going to potentially have lower net profit at the end of the day. A lot of times this is actually true because people make really bad rebalancing decisions. And sometimes even if you make your best decisions, the strategy is just not very profitable because of the impermanent loss that you're locking in. And the rebalancing can destroy your gains as well if you don't know how to do it properly. You're going to have less capital gains. You're going to have more drawdown because the exchange rate is very aggressive. If I set a range between $4,000 to $5,000 for ETH to USDC, my capital is being exchanged at that particular price range, right? To the upside or to the downside. So if Ethereum moves up aggressively to $8,000 in the next few weeks, then I would be missing out on a lot of the gains. Of course, you could hedge it with like spot holdings and stuff like that. But why would you set a tight range for this scenario if you're not going to stay in range for that long anyway, right? So it's very hard to balance the capital gains. And then you're going to have more drawdown to the downside as well. So if I set a range from like $2,000 to $7,000, I'm going to have way less of a drawdown compared to if you set a range from $4,000 to $5,000 because my exchange rate is going to be less aggressive than, like a tight range strategy, right? And it does take more time to manage, to analyze the range, to rebalance. You're going to be spending a lot of time managing these positions. And unless you have like a multi 6 figures or a 7-figure portfolio, managing your portfolio too often doesn't really give you like that much more results. And it depends on what you do with your time as well. If you're using your time to like chase the ranges, I find that you might as well just be doing like research on different altcoins and making better investment decisions rather than doing too much of this range chasing. And it often doesn't outperform wide ranges over a long period of time, over like, let's say 12 months or even like 2 to 3 years. The reason why is it's very challenging to stay in range. And if you make mistakes when you're rebalancing or when you're like predicting where the prices are going to move, then you're going to be losing a lot of money in the process. A lot of times when you're using a tight range strategy, you do need to predict where the market is going to move sideways or going to move next. So it's very hard to do, right? It's already very hard to trade, like to know where the price is going to move up or move down. And now you have to predict like, okay, where is the price going to move sideways so that you can maximize the fees. So that's the thing about squeezing the range and why I don't like it. And we could do a simple experiment, right? If you go to TradingView, there is a replay function. And let's say I started yield farming here in January of 2024. So I don't see like the future price action, right? But I kind of already know because I've been keeping up with the market. But what I want to show you is like how hard it is to actually run this type of strategy. So let's say you're here and then you're looking at the chart. Okay, maybe like this $2,000 zone is a zone of support, right? On the weekly chart, it's bouncing off of this area. And then it's a logical support zone. If you break above 2,000, you hold 2,000, that's a logical zone, right? But let's just say you want more fees. So you set like a $1,000 wide range. And that's something that a lot of people do, right? And then let's just say the price move around for a little bit. And here you can see after a short while, after a few weeks, prices did move up aggressively. I waited for a while, a week or two, and I'm not sure what to do with my capital, right? Of course, one thing you could do is to expand the upper range at the lower range to minimize like the impermanent loss, or in case the price draws down, you're going to have less capital losses when that happens, right? But a lot of times what people do instead is chase the range upwards. So let's just say maybe you waited 2 weeks and then chase the range upwards to like $4,000 and $3,000, right? And you would have still earned a pretty nice yield if the price stayed in range. And you can see price pop up and then kind of pop down a little bit, stayed in range for a while. And you can see prices did drop out of range. and then maybe you waited a little bit before you rebalance. You don't want to lock in too much impermanent loss, right? And then thankfully the prices did stay in range for a while and just keep going, right? But then here, okay, maybe the price moved down pretty aggressively. You waited for like about 2 weeks, and then maybe you wait another week here. You rebalance down once again to like $3,000 and $2,000 in this case. And then what's going to happen is a lot of times you will stay in range for a while and then you're out of range again to the upside. So when this happens, you're actually locking in a ton of impermanent loss. The reason why is when you rebalance upward, you're buying some ETH in the process, right? And then when you rebalance downward, you're selling ETH in the process. You're buying high and then you're selling low, and then you're repeating the process over time. This is why this range chasing strategy is not very profitable over a long period of time. And the only way to keep a high APR with a tighter range is to range chase, right? Because if you rebalance by expanding your range with whatever strategy, then you will be giving up some of that APR in the process. That's why I don't like the strategy. And that's why it's often unprofitable over time. And you could backtest this strategy if you want and kind of compare like the APR and the risk and reward. It's often not worth the risk and the time, in my opinion. And I don't recommend this strategy to any of my clients. So that's something to really consider twice before you running a tight range strategy. And another way to boost your APR is to be providing liquidity for different altcoins. And this is something that I would prefer compared to a tighter range strategy if I want to take more risk in the market, because I could still lose money from these altcoins, right? For example, currently I'm yield farming pump to USDC and Pendle to ETH. If these tokens lose value in the process, then of course my portfolio is going to go down in the process if the fees don't cover the capital losses, right? But the main thing is I want to be buying these assets anyway. That's why I'm yield farming these pairs and I'm comfortable taking the market risk on these assets. That's why I'm providing liquidity for these altcoins. And if you guys are providing liquidity just for the yield, that's typically not a great idea to do because you are exposed to the underlying token. You need to be very comfortable and understand exactly what you're investing in. So there's a couple good things about providing liquidity for altcoins. The first is that the APR is sustainable and you're not going to lose a lot of money if you get in at a good entry. And you could debate what a good entry is, but one of my favorite entry strategies is to enter near like a zone of support, right? For crypto to crypto pairs, this could be stuff like Pendle to ETH. I entered at this green line here at a zone of support where Pendle is undervalued compared to ETH. I'm comfortable buying Pendle here. And then if Pendle outperforms ETH again, I could be taking my profit into Ethereum. So that's a very simple like support and resistance strategy, which is suitable for like a chart that kind of like bounce from like outperformance to underperformance, right? And of course, it doesn't necessarily like will bounce. So I am prepared for the scenario where if Pendle just keeps underperforming ETH, that's part of the market risk. And then again, there's no like perfect strategy for you to be yield farming and earn a lot of yield in the process. So you've got to take on more risk if you want more reward in the process. And a lot of times there are great opportunities to get in at a good entry. For example, if you guys are yield farming AVAX to USDC, you can see sometimes when the prices are really cheap, that's the best time to actually deploy into an AVAX and USDC pool, assuming you're swapping from stablecoins. The reason why is you're going to be able to ride the price appreciation upwards, right? If I don't plan to compound down and I'm not happy to buy at a higher price, for example, if AVAX shoots up to $50, I'm not comfortable buying at that price, then I typically don't want to be entering the pool there. I would rather wait for the prices to be cheaper where the market condition and the risk and reward is favorable to be entering into these pairs. Even if you didn't get the perfect entry, if you entered at $20, for example, in an AVAX to USDC pool, you would have been sitting in some positive divergence loss here, meaning that you would gain a net US dollar value on your liquidity pool, even without counting for the fees, right? So that's how I prefer to run my strategy. If you get in at a good entry, the APR is sustainable and it is purely profit if the prices do drift upwards. And it can complement a blue chip portfolio You definitely don't want to go too heavy into altcoins if you're not planning to buy that much altcoins anyway. For example, you're comfortable with 20% altcoin in your portfolio, then you would only be providing liquidity for roughly 20% at max, right? So it could complement a blue chip portfolio. I do have client portfolios that I help manage. We grew that portfolio from like 150K to around like 250K right now. And most of it is in blue chip, right? Like 70, 80% is in blue chip assets like ETH to USDC or just straight up holding Bitcoin, buying and hold. So you could be combining like different strategies like blue chip LPs, altcoin LPs, buy and hold to actually build up your portfolio. So this is less management and less risk if you use wider ranges. And in my opinion, it's easier to turn a profit with altcoin LPs rather than range chase on a lot of those blue chip LPs. And lastly, it's great if you already want to buy and hold some altcoins. Anyway, a lot of these altcoins are traded on decentralized exchanges, which means that when people trade these alts, you're going to be making money in the process. So even if the prices go down from time to time, you got to be very comfortable with these assets, right? And you want to be buying more when the prices are cheap rather than like when the prices are very high, people are euphoric, then you're buying a ton of altcoins. That's typically not the way to go. And the downside with altcoins is that there's more risk of loss from bad performance. This year so far, altcoins have been very weak compared to last year, but I believe that we will turn around when there's more euphoria in the market. People tend to take more risks when the prices are trending up and is breaking new highs. So I believe that altcoins would outperform in the next 6 to 12 months here, but we do need to take profits more aggressively simply because there's more risk of loss, right? Sometimes altcoins do move up by like 2 to 3x, 5 to 10x. And if you don't take profits, a lot of times the prices will draw down back to your entry or even below it. It does take more time and experience in picking the winners. For example, a lot of gaming altcoins got completely destroyed, so you could have lost a ton of money in the process. And there are really good traders and investors who invested into these gaming altcoins, and they're not stupid, right? They did all of their research, they had a thesis behind it, but it just doesn't play out. So that's part of the risk of loss here. And you need more time and experience to be picking good altcoins and proper risk management when you're doing this. And for most people, that's why I say, you got to really consider if you're going over like 20 to 30% allocation into altcoins and see, if you actually have a good chance of winning at this game or not. And the lower the market cap, the higher the risk as well. So you could be yield farming like the larger caps for less yield or like the lower caps for higher yield, higher return potential, but higher risk. So there's a lot of different strategies that you can run. But I do prefer this over squeezing the range or over leveraging. But here's a few things to keep in mind if you guys are providing liquidity or yield farming. The first is high rewards often mean higher risk. If there's like a lot of great opportunities where the reward is really high, but the risk is really low, what is going to happen is that smart investors are going to find that opportunity and then the rewards are going to drop to match the risk, right? So higher rewards often mean higher risk. So you got to really be careful with like higher APR stuff. Be very careful of taking too much risk. This could absolutely destroy your portfolio, for example, over leveraging or putting too much capital into a tighter range strategy. Like if you're going all in into like a tight range LP, and then you're also using that for like different altcoins, then you could actually lose a lot of money very, very quickly. I've talked to a ton of DeFi investors or yield farmers, and they often lose a ton of money by taking on too much risk, either through like range chasing, too much leverage, picking bad altcoins, or combining the 2 or 3 strategies, right? It's often too risky to stack like 2 to 3 strategies together. For example, if we go back to DeFi Tuna, and then you're yield farming something like, let's say, Farcoin and Sol, but then you're also using like max leverage, right? Then this becomes very, very high risk, and you can lose a ton of money very, very quickly. So that's something to consider. I typically don't like to stack the risk too much. Even with the altcoins, I like to go wider rather than tighter. If you run like really tight range altcoin strategies, that could be very risky and you could lose a lot of money in the process, especially if these altcoins do drop by quite a lot, like what we saw in the last couple of months. And lastly, before I hop off here, the thing is you don't need to rush to grow your portfolio. A lot of times we make bad investment decisions because of greed, and we're trying to rush a process here. It takes time to build wealth and to compound. A lot of times people with a lot of money, they either got in like really early or it took them a long time to actually accumulate that wealth, right? But here's a few tips to consider when you're trying to build out your portfolio. The first is to compound your profits consistently over time. And this doesn't matter if you're investing, you're airdrop farming, you're trading. If you compound your gains, you're going to have more in the future, right? If you cash out all of your gains, you're not going to be building your portfolio. So if my portfolio goes up from like 200K to like 300K, I would probably take some out, like maybe like 10K, 20K, 30K, but I'm going to be compounding my profits if my goal is to grow to 1 million faster rather than slower, right? So compound your profits consistently over time. Your yield doesn't all have to go back into the same pool, right? Like just selling your fees into stable coins and then lending them out. That's also a way to compound your profits. That's what I do as well. And then the second is to add more active income to your portfolio. Right now, I'm pretty happy with my current portfolio, but if you want to grow your portfolio quickly, you would be adding more active income into the portfolio, right? If you make a ton of money, that's also a really great way to grow your portfolio. Investing, sometimes you will be sitting in losses for a very long time. For example, gold has had like a huge run up in the last few years, but there are periods of time, if we look at the gold chart here, where the prices just move sideways for like almost a decade, right? You see over here in like 2013 to like 2019, gold prices basically move sideways. So there are periods of times where the market moves sideways. If we go to SPX as well, for example, after the dot-com bubble, it took over a decade for the prices to break out at that levels, right? That's why it's very good to have a source of active income. You don't want to rely purely on investments unless you have a larger portfolio. And again, this is for if you're trying to grow your portfolio, right? Adding more active income is one of the surest way to grow your portfolio over time, rather than trying to optimize too much yield or trying to take too much risk in the process. And this grows your net income per year, even if you generate a less APR, right? Even if you generate 10 to 15% APR, that's already much, much better than like traditional finance investments. And if you just compound that over time, then you would be making more money over the next 5 to 15 years. So that's pretty much it for this video, guys. Hopefully that was helpful and kind of explain like the risk and reward behind each strategy. If I got something wrong, then feel free to leave it in a comment as well. And if you want to learn more about yield farming and DeFi, be sure to check out the other videos on my channel. Thank you once again for watching. I'll catch you next time.